Big tech earnings are usually framed as a scoreboard. Revenue up, margins down, stock up, guidance cautious. But the 2026 earnings cycle reveals something deeper than quarterly performance. It reveals a structural transformation in how the largest technology firms allocate capital, govern risk, and design their own industrial base in response to artificial intelligence. This is not a software cycle. It is an infrastructure cycle. For more than a decade, major technology companies scaled primarily through software leverage, cloud services, advertising platforms, app ecosystems, and subscription models all shared one institutional feature: low marginal costs once the system was built. AI changes that equation. Artificial intelligence at scale is not just code. It is compute, energy, land, cooling systems, fiber networks, specialized chips, and continuous hardware refresh cycles. The firms leading AI development are now operating with capital intensity closer to utilities and industrial manufacturers than to traditional software companies. That shift is visible in earnings. Capital expenditures among the largest technology firms have surged to levels that would once have been associated with oil majors or telecommunications giants. Tens of billions per company, per year, are being directed toward data centers, custom silicon, networking infrastructure, and AI training capacity. Institutionally, this represents a new form of corporate commitment. These are not flexible operating expenses that can be trimmed next quarter. They are long-lived assets built on the expectation of future demand. Once constructed, they create fixed cost structures that must be justified through scale. This is the first key mechanism shaping the earnings story: capital intensity. When capital intensity rises, the margin for strategic error narrows. Companies must correctly predict not just technological trends, but market adoption, pricing power, and competitive positioning over multi-year horizons. That brings us to the second mechanism: platform competition. AI is not just a feature layered onto existing products. It is being embedded into search, productivity software, cloud services, advertising systems, developer platforms, and consumer devices. Each firm is racing to make its ecosystem the default environment in which AI tools are built and used. This is an ecosystem land grab. Cloud providers want enterprises to build AI workloads inside their infrastructure. Productivity platforms want AI assistants deeply integrated into daily workflows. Advertising networks want AI to optimize targeting and content creation. Device makers want AI features tied to their hardware ecosystems. The more deeply AI is integrated into a platform, the harder it becomes for customers and developers to leave. That lock-in effect is the long-term prize. But locking in an ecosystem requires enormous upfront spending. The earnings question, then, is not whether AI is transformative. It is whether today's spending creates durable competitive moats or simply inflates cost structures without guaranteeing dominance. This leads to the third mechanism: investor governance. Public companies do not operate in a vacuum. They operate under the discipline of quarterly reporting, shareholder expectations, and capital market scrutiny. When capital expenditures rise dramatically, investors begin asking when those investments will translate into revenue and profit growth. In the early phase of the AI boom, markets rewarded ambition. Announcements of AI integration and infrastructure build-out drove stock prices higher. But as spending continued to escalate, investors began to shift from enthusiasm to evaluation. Are AI features driving measurable revenue growth? Are cloud AI services increasing utilization enough to justify new data centers? Are margins improving or being compressed by infrastructure costs? These questions are now central to earnings calls. When one major firm increases its capital spending forecast without clearly linking it to near-term revenue acceleration, the market reacts, not because investors doubt AI's importance, but because the institutional balance between long-term strategy and short-term accountability is under strain. This is the governance tension of the AI era. Corporate leadership teams are making long-horizon infrastructure bets, while investors evaluate performance on a quarterly cadence. Boards, CFOs, and executives must justify not only the technology roadmap, but the financial architecture that supports it. There is another institutional layer here: debt. Some technology firms are financing portions of their AI infrastructure through corporate bond issuance, rather than solely through retained earnings. That introduces leverage into balance sheets that were once characterized by net cash positions. Leverage amplifies both opportunity and risk. If AI investments yield strong returns, debt enhances equity performance. If returns are delayed or weaker than expected, debt constrains flexibility and increases financial vulnerability. In other words, the AI race is not only a technology competition, it is a capital structure experiment. We are watching a handful of firms attempt to build digital infrastructure at planetary scale while navigating the constraints of public markets. Their success or failure has macroeconomic implications because these companies now represent a significant share of equity indices, investment flows, and global technology supply chains. This concentration creates systemic exposure. If a major hyperscaler slows investment abruptly, suppliers of chips, networking equipment, and construction services feel the impact. Labor markets and technology hubs adjust. Venture capital funding patterns shift. The ripple effects extend beyond the firms themselves. That is why these earnings reports matter beyond their headlines. They are signals about the sustainability of an economic model in which digital platforms evolve into capital-intensive infrastructure providers. They reveal whether firms can maintain profitability while absorbing the cost of AI expansion. The early evidence is mixed. Some firms are showing revenue acceleration tied to AI-enhanced products and cloud services. Others are experiencing slower growth in legacy segments, making the burden of AI investment more visible on their margins. The institutional story is still unfolding. What is clear is that the digital economy is entering a new phase. The dominant firms are no longer primarily software companies with asset-light balance sheets. They are becoming hybrid entities, part platform, part infrastructure provider, part industrial operator. That transformation alters risk, governance, and economic influence. It raises questions about competition policy, energy consumption, supply chain resilience, and the distribution of economic gains from AI. But at its core, it is a question of capital allocation under uncertainty. The firms that navigate this transition successfully will not only lead in AI capabilities, they will have mastered the institutional challenge of aligning long-term infrastructure strategy with the financial expectations of markets. That alignment, more than any product launch or model release, will determine the winners of the AI era. Because in the end, AI is not just code, it is capital. And capital, once committed, reshapes everything. For continued institutional analysis of how corporate governance and capital allocation shape economic power, subscribe.